Hello there, and welcome back to Imaginr. Today we're going to talk about savings accounts and how they actually work. Most people have a savings account, but the interest rates are often extremely low. You might wonder what is the point of this in the first place, and so today we're going to look at what banks actually do with your deposits, why saving rates are often so small, and what the deal is with high-yield savings accounts. So, simply put, what is a savings account? It is one of the most basic financial tools people use. The idea is simple. You just deposit money into a bank. The bank is supposed to keep it safe, and in return, you earn a small amount of interest over time. I've got a savings account. I'm sure you do too. People often put their emergency funds or short-term savings in there. It's not designed to grow money quickly. It's instead meant to protect money while keeping it easily accessible whenever you need it. But historically, savings accounts played a much bigger role in helping people grow their money. In the past, it was not unusual for banks to pay several percent in interest. Nowadays, if you log into your savings account, like I think my interest rate is literally 0.01%, that is a far cry from what it used to be. People could actually keep their money in the bank and actually see a balance grow steadily without taking much risk. Now, today, like I said, the interest rates are pathetically low. In my case, like I said, it's, I think, literally 0.01%. I might get a penny or two a month. It's ridiculous. And this leaves a lot of people, like you, like me, I'm sure, wondering, why is the return so small? What is the point of even offering that? Why does it exist? Well, to understand that, you first have to understand what the bank is actually doing with the money that you deposit. When you deposit money into a savings account, the bank doesn't just store it in a vault somewhere. Instead, that money becomes part of the bank's lending system. Banks collect deposits from millions of customers, and those deposits become the raw material that the bank uses to make loans. So for example, when someone takes out a mortgage or an auto loan, or maybe a cash advance on a credit card, the money often originates from the deposits held by the bank, and those deposits usually come from the customers. This means that your savings account is indirectly helping fund other parts of the economy. Mortgages obviously allow people to buy homes, or business loans help companies expand. Credit cards allow people to borrow money for short periods of time. Much of that is funded by the deposits made by bank customers. The bank is acting as the middleman in the system. It gathers deposits from savers and lends money to borrowers. But the important thing to distinguish in this system is the difference between the interest the bank pays the depositors and the interest that it charges to borrowers. So what do I mean by that? Well, the core business model of a bank is built around something called the interest spread. This simply means that the bank borrows money at a lower rate and lends it out at a higher rate. For example, let's say a bank is paying savings account holders 1% interest. And let's say that's an annual interest. So you got $100 in there. At the end of the year, you would have $101. At the same time, it might charge 6% interest on auto loans or much higher rates on credit cards. The difference between those rates is where the bank is making money. It's giving you 1%, but it's charging 6%, so it's got a return of 5%. If the bank collects large amounts of deposits at low interest rates and lends that money out at higher rates, the spread between those numbers generates the profit. And this is one of the reasons why savings account rates are often so small. From the bank's perspective, the lower the rate they pay the depositors, the larger the spread they can earn when they lend that money elsewhere. Of course, banks still need deposits in order to make loans, but then it presents the question of how much do they actually need to pay customers to keep those deposits coming in. Many people assume that banks compete aggressively to attract deposits, that they want you to deposit your money in their bank, and they're going to advertise that heavily. But in reality, most large banks don't need that. Major banks already hold enormous amounts of customer deposits. Millions of people keep their money in the same accounts for years without moving it. And because of this, banks often have little incentive to raise savings rates. If customers are not actively moving their money elsewhere, the bank can continue paying very low interest rates without losing money deposits. And convenience plays a big role. Customers may keep their savings at the same bank where they already have a checking account, a credit card, or a mortgage. Even if another bank offers slightly better interest, many people might just leave their money where it is because they want to have access to their checking account or their credit card account. They don't want the hassle of having to deal with two separate banks and two separate accounts. So as a result, traditional banks can maintain extremely low savings rates while still holding vast pools of deposits. But of course, not all banks operate this way. Some institutions compete much more aggressively for deposits, and this is where high-yield savings accounts come into the picture. Pretty self-explanatory. It's in the name. It is just a higher yield savings account, meaning that they often pay significantly higher interest than traditional bank accounts. For example, like I said, my standard savings account rate is like 0.01%, right? It's ridiculous. But then I have my high yield savings accounts, which I think it's like 3.8% or something. I don't know what it is exactly. That is a ridiculous difference. And the reason that these accounts exist come down to two reasons: competition and cost structure. Many high-yield savings accounts are offered by online banks. And because these banks operate without large branch networks, without operating physical locations, their operating costs are often much lower than traditional banks. They don't have as many expenses with dealing with physical branches, so they can afford to pass more of that interest earnings back to the customers. But even so, the underlying system still works the same way. The bank collects deposits and uses them to fund loans or other financial activities. The difference is simply that some banks are willing to share more of that interest with their customers than others. Maybe you could call that greed, but that is pretty much what the idea is. Savings account interest rates are also influenced by something much larger than any individual bank. It is the Federal Reserve. The Federal Reserve, or the Fed, people call it different things. It is just the national bank in the US, and it sets what is known as the federal funds rate. This is the interest rate that banks charge each other for short-term loans. And while this rate does not directly control savings account interest rates, it does strongly influence them. When the Fed raises interest rates, borrowing across the economy becomes more expensive. Mortgage rates, car loans, credit cards, if those interest rates go up, it's more expensive to have those loans. And when that happens, when banks are earning more interest from loans because the interest rates are higher, they may raise savings rates slightly in order to attract deposits. And when the Fed lowers rates, the opposite happens. Loans become cheaper, and savings account yields usually fall as well. This is why savings account interest can change over time. In some periods, rates may be relatively high, while in others they drop to negligible numbers. The overall direction of interest rates in the economy plays a major role in determining what banks are willing to pay savers. Let's talk about inflation briefly. Even when savings accounts pay interest, inflation can often outpace the real value of your money. Inflation, as I'm sure you know, measures how much prices increase over time. As inflation goes up, your money loses value, things become more expensive, and if inflation is running at, let's say, 3% per year, but your savings account only earns 1% interest, your money is losing 2% per year. This means that while your balance might slowly increase, it might look like you're earning money, what that money can actually buy in the real world in the future may actually decrease. And this is why it is typical for people to treat high-yield accounts or even just normal savings accounts as a place to house money for a brief period of time. It is quite unlikely that you will ever find a savings account that is able to outcompete the stock market. Savings accounts prioritize accessibility and convenience, but they are rarely designed to significantly grow wealth over long periods of time. So I hope you learned something. Hope you see now why interest rates may be what they are and why banks tend to keep them that way. Let me know what other topics you want to see me cover in the future. In the meantime, I'll see you in the next one.